Thank you very much, Raina. As far as my poor French allows, I think you've just given my speech and done it in a much more efficient way than I would have done it. I'm very pleased to be the middle speaker of a series of three in a very logically oriented or very logically organized conference with Martin Hellwig talking about the macro and macro-prudential issues, and then tomorrow Philip Hildebrand talking about the regulatory issues, and I'm what we call the meat in the sandwich, and I'll talk about the institutional questions. If I were giving this talk in the US, I would start with an apology, because in the 1980s, a number of academics and myself spent several years trying to liberalize the American financial markets, in particular trying to eliminate the so-called Glass-Steagall legislation, which separated the securities industry from the banking sector in 1933. We had 66 years of that separation, and our argument was what you need is a level playing field. You have regulation by function, so if you're going to be in the securities industry, you're going to be regulated as such. If you're going to be a bank, you're going to be regulated as such. But you eliminate these artificial restrictions and then let banks and other firms develop their own strategies. And if bigger is better, they will get bigger. And if broader is better, they will get broader. But let that be the determination of the market and not regulation that was put in place in 1933. We finally got our wish in 1999, and the Glass-Steagall restrictions were eliminated. And within 2 years, every major bank was up to its neck in the biggest set of corporate scandals we ever had in the U.S. Enron, WorldCom, Global Crossing, and so forth. And in almost every case, what they were doing was chasing fees, particularly investment banking fees, in this new area that they previously couldn't do, and basically backloading the exposure onto their credit books. So I felt like the dog who caught the bus. If you really want to catch the school bus, one of the worst things that happens to you is when you actually catch the school bus and you get rolled over by the wheels. So if this were the U.S., I would apologize for being part of the liberalization move in terms of its unintended consequences. And I think one of the things you learn is there are always unintended consequences, and there will be going forward. The second thing is we don't know very much about institutions, at least not enough. So if we take, let's say, more or less matched pairs, take UBS and Credit Suisse, why would it be that, challenged by the same global turmoil, the same set of market conditions, the same set of monetary policies, which Professor Hellwig mentioned yesterday, why would it be that one of those two firms does relatively well and the other one crashes and burns and puts a huge burden on the Swiss public? Why is that? These are both well-managed firms historically. They've got a lot of smart people working for them. Why is it that you see such different outcomes? In the U.S., you take Merrill Lynch and Goldman Sachs. Two investment banks. One of them does extraordinarily well. The other one basically dies and is taken over by Bank of America. In the commercial banking area, you take Wachovia and Wells Fargo. One of them survives the process extraordinarily well. The other one ultimately gets acquired by the first. So there are a lot of unexplained variables that academics still have to come to grips with. A lot of them, I suspect, have to do with governance, have to do with the role and symmetry of risk control against revenue generation. Issues like that sit in the hearts of these firms, which arguably explain some very, very different outcomes. So that's the kind of thing people like me are now interested in as we go forward and try to come up with an operating platform that will retain some of the benefits of what we've had and at the same time remediate some of the weaknesses. So the idea is, first of all, to talk a little bit about what do we expect from a financial system as ordinary people. Secondly, we know we have large, broad institutions, which, as Rainer just mentioned, are either too big to fail, or too complex to fail, or too interconnected to fail, and consequently have systemic impacts which need to be dealt with after the fact, often at great cost to ordinary people. So the second issue is, how do firms get that way? Why do they grow so big and broad and complex that ultimately they become systemic? The third issue is, how do you take that story and impose it on the current environment? And what role did these large, complex financial institutions actually have in the disaster that we've just been living through? And it is a disaster. It's a disaster for everyone. And when you look at the workout of the overhang, we're talking about slower growth. We're talking about real costs to ordinary people, which will last over a decade. This is not a free lunch, and it's going to be remediated either through fiscal measures or through higher inflation in some countries and so on. So the question is, what role did they actually have? And if they had a key role, maybe that's a reason for dealing with them in a certain way to make them less systemic. And then we'll talk about these two issues that Rainer mentioned. First of all, there are a lot of proposals on the table. In the US, UK, Switzerland, in some cases Switzerland is actually ahead of both the US and the UK in thinking through some of these issues. Can we rely on those proposals, if implemented, to basically do that, to reduce the sensitivity of the system while retaining its efficiency and innovativeness? If you give up on that idea, then the alternative is structural remedies, and you basically say that we're going to chop out of public utilities. Banks are public utilities. They run the payment system. They are the transmission belt for monetary policy, just like the railroads or the water companies. They have very, very strong public utility characteristics. Should a public utility be allowed to run a casino inside the same structure? And if the answer is no, and you can't remediate it using the traditional techniques, then clearly a structural remedy may be necessary. So that's why I call it sort of breaking up the banks. It sounds more dramatic than it actually is, but it is I would consider it to be a second best solution. Best solution would be for the regulatory process to be changed and for the banks themselves, who are systemic, to draw the necessary consequences through the governance process. So here's the way we normally think about this. This chart gives you all the answers to all the questions you ever had about finance, about the financial markets. You can have this for free and reduce it to a little wallet size, and at a cocktail party you can look a lot smarter than you actually are. So what is this? Well, it's a flow of funds chart. The beauty of it is we have good data. We know where money comes from. We basically are looking at savings or usable funds on the bottom right. About 80% comes from households. Easy to measure. We take household after-tax income and subtract consumption. And what's not consumed is saved and goes into the system. Then we have corporate savings, for example, cash and cash equivalents on the balance sheets of companies. And then we have government savings, such as external reserves of central banks, sovereign wealth funds, and so forth. So these three sources of funds enter the system, and they go either into financial intermediaries, I've noted it A, into a bank or a credit institution. Second alternative is those savings could be used to buy securities. That's the vertical arrow going up to the yellow box, sales of stocks, sales of bonds to households, and so forth. And the third option is those savings could go into fiduciaries or asset managers, who in turn will manage those assets on behalf of the ultimate owners, like pension funds, hedge funds, mutual funds, and they in turn will buy assets in the market. So notionally, those are the only three channels that funds could enter the system. If a large percentage of those funds go through the banking system, we call it a bank-driven financial system. If a large percentage goes into the capital markets, either directly or indirectly, we call that an Anglo-Saxon or capital market-driven system. And when you look around the world, you have very, very different financial architectures in terms of the sources of funds. On the right-hand side, you've got the end users. Obviously, the same three sectors. Households borrow for housing. That's the mortgage sector. And the mortgage lending, often through banks, eventually ends up in the capital markets through the securitization process that Professor Hellwig talked about yesterday. The second type of household finance is consumer finance, credit card loans and so forth, and that takes the same path. It usually is made, the original loan is made by a bank, but very often credit card loans are also securitized. So they end up with as asset-backed security. Then we have corporates who can issue bonds into the market. They can also take loans from banks, which in turn can be securitized through collateralized loan obligations. And finally, you have governments who normally would issue their debt using some kind of an auction process to the market. So the question is, how do we join these two pools of users on the left and sources on the right? And as I said, one is through the banking system, deposits on the right, loans and advances on the left. Second is through the capital markets, and here I've just broken out the three major functions. One is origination or underwriting, bringing a security to the market. Second is brokerage and trading, and I've divided trading into proprietary trading for the firm's own books, and secondly, client-driven trading for either investor clients or borrower or issuer clients, and then ultimately distribution of securities either to institutional investors or to end users, that is to retail. Sitting on top of all this is the infrastructure. On the top left, you have information infrastructure. Information is extremely important in this industry, especially information asymmetries, where different people have access to different information. And there we have market data, which has to be accurate. It has to be immediate, so things are priced correctly on a continuous basis. Then we have research, which deals with interpretation of information, stock research, for example. Then we have the ratings industry, which has become extremely controversial in today's world. Standard & Poor's, Moody's, and Fitch, who look at the interpretation characteristics of fixed income securities. And then we have portfolio diagnostics, that is, how do investors perform, and we have a compliance infrastructure. And on the right-hand side, we have a transaction infrastructure. Payments system has to work reliably. It has to work efficiently. It has to handle large transactions under those conditions. You have exchanges, stock exchanges, foreign exchange, and so forth, some of which are on exchanges, some of them are over the counter. Then we have clearance and settlement. Clearly, if I sell you a bond, you would like to get clear title to that bond, and I would like to get my cash under certain pre-specified conditions. So that is what we call the plumbing of the system, which has to work efficiently, accurately, and quickly. And then finally, we have custody. Somebody has to hold on to these securities over their lives and on behalf of the ultimate owners. So when we talk about financial intermediation, we have three advantages that it takes to be a financial intermediary. You've got to have better information than the client, so you can add value to the client. Or you have to have better interpretation of whatever information exists, so you can advise the client in a suitable way. Or you have to have lower costs than the client. If you're a financial intermediary, or if you're any kind of intermediary, everybody is trying to cut you out. They're always trying to disintermediate you. So in order to remain a financial intermediary, you have to have some combination of those three advantages. And that becomes particularly important when you talk about the risk transformation issues, especially with respect to derivative contracts. And finally, you have the whole issue of direct connect at the very bottom, where, for example, a corporation might issue its obligations directly to an investor instead of first issuing them and having them underwritten by an investment bank, and then ultimately being distributed to an investor. And what we're always doing in the academic world is watching this map and seeing how the chemistry changes. For example, banks in the U.S. used to have, when I was in college, banks had about a 70% market share of U.S. intermediation. Today they have 19%. All of the rest of U.S. intermediation has gone into the capital markets. In Belgium today, I just looked at the number, banks continue to have almost 60% of the intermediation flows. So we watch not only the differences across systems, but also how they evolve over time. And then, from my point of view today, what kind of institutions map onto this grid? For example, you can be just a community bank or a regional bank, and you only operate in this orange box. And we have in the U.S. today almost 8,000 banks. The vast majority are local community banks that do extremely well. They're not involved in the capital markets. They're not involved in a high level of financial intermediation, but they do have a high degree of closeness to the clients, both on the deposit side and on the lending side, and they continue to be viable intermediaries. Last data I saw is that we have about 400 banks a year which are acquired by other banks, but we keep having about 8,000 banks. So what does that mean? Every year we have 400 new banks that are created in small towns. This is a vibrant industry, even in the case of the U.S., which has moved very heavily into the capital markets. Or if you don't want to be a bank, you can be a broker-dealer, an investment bank. That means you operate across the yellow businesses. So you have origination, usually that is coterminous with merger, acquisition, activity, and corporate finance. And then you trade and provide liquidity, and then you distribute. So a classic U.S. investment bank, or what we call a full-service investment bank, is in those yellow boxes. Or you can be a universal bank. You can be in the yellow boxes and the orange box also. And in addition to that, you can also be a custodian. You can run part of the payment system and so forth and so on. So one of the questions is, how do we map the institutional structure against the functions? So I started this by just looking at functions. That doesn't necessarily tell you what types of institutions are optimal to carry out those functions. So if we take a look at what we're looking for from the system, we want it to perform, and there are at least 5 areas. One is we want it to be efficient. Efficient means, in one sense, the difference between what the saver receives on his savings and what the borrower has to pay, just as far as the system as a whole is concerned. So if the savings returns are 3%, borrowers on average pay 6%, then you've got 300 basis points or 3% in the middle, which goes either into costs or losses or profits. Right? So if you're looking at a system with 3% spread, and you look at another system with 6% spread, you would say the first system is more efficient than the second system. Right? Secondly, we're looking at innovation. We want the system to throw up new products and new processes which actually add value to clients, whether the clients are savers or investors or whether the clients are borrowers. So we want a system which is, in economics we would say, statically and dynamically efficient. Those are the first 2 objectives. Third, we want a system that's fair. Nobody wants to be cheated. And if a market is unfair or somehow tilted, people have options. They move their business to other markets which they consider to be more fair. So we generally call that equity, horizontal equity and vertical equity, which means you treat similar people similarly or different people differently, but in a way that's clearly specified. Right? Fourthly, you're looking at competitiveness. We're operating in a global market where national boundaries often mean very, very little. And if you want to be a competitive financial center, and Switzerland is clearly one, so is New York, so is London, and we're in a life and death struggle with London almost all the time in terms of attracting transactions. What we want is a system which is, again, efficient, innovative, and fair, and we want a system that's as lightly regulated as possible, consistent with stability. That's what we want. That's what we call the net regulatory burden. So we've had a lot of studies in both London and New York about how different regulatory initiatives might affect our competitiveness one against the other. And the system is extraordinarily sensitive. Small changes in regulation create huge changes in financial flows. And then lastly, you're interested in stability and robustness. You want a system that achieves all of the other objectives, but at the same time absorbs shocks, because there always will be shocks. It could be an oil shock, could be an emerging market shock, could be some other shock we don't even know about in the real estate sector or whatever. We want the system to correctly apportion the losses, to correctly allocate the risks ahead of time, and we want the system to survive and to continue to provide its essential functions. So you can take different financial systems and just benchmark them against those five objectives. I was just talking about, I did this one time in Singapore. I was asked by the Monetary Authority to benchmark the Singaporean system, and I almost got kicked out of the country. In fact, my presentation should have been very close to the airport, because they don't like anything except excellent. They're extraordinarily smart and extraordinarily arrogant. So anyway, here's an example. This is the financial services sector mapping the institutions onto the functions in 1950 for the U.S. And you can see we have the various activities that I mentioned before: payment services, savings products, asset management, and so on. And then we had different types of institutions that carried those out. So back in 1950, ancient history, this is the way the U.S. system looked. So banks, insured depository institutions is the term I use here, were involved in banking activities. Insurance companies were involved in insurance activities, but were not permitted to be involved in banking activities, or vice versa. And then you had securities firms, broker-dealers, who were involved in the securities markets, but could not be involved in banking, or vice versa. So this is the way the system was then. This is the way the system is now. You see a difference between this one and this one? So what we've had is everybody gets into everybody else's ballgame. So if you're interested in asset management, for example, as a client, you can get that from insurance companies, you can get that from banks, you can get that from broker-dealers. And many of us think that this is actually not such a bad situation, because competitive dynamics are particularly intense when you're competing across strategic groups, not just within strategic groups like banks against banks, but because, for example, a new idea which could actually damage banks because it cannibalizes their profitable business might come up from the insurance industry, or it might come up from a foreign bank like ING Direct in the U.S. No American bank ever would have come up with that. It had to be a foreigner who had no stakes in the existing system to invade the system and effectively stir the pot. So we like to see a high degree of cross-functional competition. This is the European system, as far as I can tell. Again, this is a little bit uncredible because the systems are so different from each other. So if you try to compare the Danish with the Spanish, it's almost nonsensical. But nevertheless, in Europe, we typically have a system which is heavily dominated by banks and insurance companies. We have very, very few specialists. We have basically no independent broker-dealers anymore. We have some independent asset managers, but very often they get acquired by large banks. So the U.S. system and the European system do look quite different, with the European system heavily dominated by universal structures compared to the U.S. system. So the question is, how do these institutions get as large and broad as they are? And secondly, what are some of the implications? So here's the McKinsey diagram. You know, what's the story? The story is bigger is better. Right? Why is bigger better? Because you got a bigger market footprint. You have a larger market share that gives you pricing power. You have economies of scale, which reduces your unit costs. There are all kinds of arguments why bigger might be better. The second issue is broader better, is doing insurance as well as banking, as well as asset management, for example, combining those, is that worth more than the individual businesses are by themselves? And that relies very heavily on what we call cost economies of scope and revenue economies of scope, or what bankers would call cross-selling. Right? So the question is this in fact true? Because if McKinsey, I'm just putting their name on here because I like to criticize them, but and they really wouldn't put it this way. But is McKinsey right? Because if at the end of the day, if you leave them alone, who is going to inherit the earth? And it'll be the big guys through a consolidation process, and possibly some specialists who don't have conflicts of interest and other complexity problems, who can continue to operate profitably on a regional basis or a functional basis or whatever. And you would say the ones who really have the problem are the ones in the middle. And they would have a choice. They could either become consolidators and move to the left, or they can become specialists like the Bank of New York did, or other firms like that who are still large but function in one particular area where they have a comparative advantage. So here's what's happened in the U.S. As I said, we're a good place to do good research because we have a large number of banks, as I said, 8,000. We have a single currency, have had since 1865, since the end of the Civil War. We have a single regulatory system. So we don't have the problems that you have when you try to do international research, where you're looking at exchange rates and other complexities. So what's happened? Well, the top 10 banks in the U.S. have, in fact, gained market share, and gained dramatically from more or less, well, actually more than doubling their market share since 1994. The next 15 banks have lost dramatically, as have the other categories. So it appears that in the U.S. we're seeing, despite the fact that the number is still the same, the consolidation of market share has in fact been growing. What's happened as a result of the crisis? It's turbocharged the process, because as a result of the crisis we've had a number of big mergers. I mentioned Merrill Lynch, Bank of America, Wachovia, Wells Fargo, Bear Stearns, JP Morgan Chase, which in order to stabilize the system at the moment creates even greater degrees of concentration, consequently even more systemic institutions than before. In fact, in the U.S. we have a cap on bank deposits captured by any given firm of 10%. Americans are very, very skeptical of concentration of power. And this is a political cap which says 10%, and you can't grow beyond that because we're concerned about market concentration. Bank of America currently has 13.5%. So they're in violation by 3.5%, and they're allowed to do that under forbearance, which means we're living through unusual times, and we expect you over time to build that back down to 10%. Bank of America says, wait a minute. The reason we're at 13.5 is because we're so good. And consequently, we think you should increase the cap to 20%. So that's their argument, and they have an army of lawyers arguing that. And of course, the public interest may have a different view. So we see this consolidation in the U.S. case. We also see it, I could draw this map similarly for Europe. We also see heavy consolidation in Europe, mostly internally within countries, as opposed to cross-border, although there's a significant amount of cross-border as well. Secondly is scope. Is it worthwhile as a bank to also do insurance? This has been an argument that's gone on for forever. Bancassurance is something that in some environments works extremely well, and other environments it's a complete disaster. In the United States, it's a complete disaster. People like to buy their insurance from independent or tied agents, and that's an extraordinarily different model than buying insurance from a bank in the insurance group within that particular bank. Similarly, should a bank be in the securities business? Should a life insurance company also be a broker-dealer? And these are scope questions, and in many cases there are not easy answers to come by. So how do banks get to be large, complex financial institutions? Very easy. What they try to do is they try to access the most profitable and the largest and the most rapidly growing markets, right? Secondly, they try to maximize economies of scale, where economies of scale are available, and there's lots of activities where economies of scale are large, and there's some like merger advice where they're virtually zero, right? Thirdly, you want to try to maximize scope and cross-selling, and you want to try to avoid diseconomies, for example, conflicts of interest. The broader you get, often the more difficult conflicts of interest tend to be to manage, as does complexity. So you can put all that into a little matrix. So you put all the activities you do on the one axis, you put the clients you serve on the other axis, and the geographies on the third axis, and your strategy is revealed by what's inside that box. And you try to maximize the value of the firm within that. And on the right-hand side, you simply have a valuation story which says what you want to do is increase revenues, expected revenues, reduce expected costs, and reduce the risk associated with the firm. So this is the job description of a chief executive of a bank, right? Revenue gains, cost reductions, risk reductions. So in trying to push that model, clearly firms become very large. Very often the execution device is acquisitions, growth by acquisition. Very often the market rewards firms for doing that because of the presumption that you're going to see disproportionate revenue growth or significant cost efficiencies by closing branches and other kinds of measures like that. So bankers are just acting rationally, and they get big by doing that. Here's an example that we did a couple of years ago for the investment banking division of Morgan Stanley, one of our surviving, well, it's a bank holding company now, but investment bank. And here what you do is you take what they did for themselves. I was just sort of catalyzing this. They took the regions, North America, Latin America, and so on. Then they took the products on the horizontal, and then they took the industry groups who they serve, for example, chemicals, oil and gas, media, and they built a matrix like that and basically used that in terms of resource allocation and risk allocation. So this is just a logical way of thinking about it. At the same time, if you think about a large institution, which is also extremely broad, you can put it into a matrix like that, and you put all the activities that you do on one axis, all the activities that you do on the other axis, and each cell represents a linkage. For example, insurance and banking, or merger advice and bridge lending, for example. And we can extract potential values from this particular matrix. It also involves, the matrix has good aspects in terms of cross-linkage. It also has potential problems with respect to conflicts of interest. For example, I've divided this into wholesale clients, retail clients, and domain transition clients. And the broader you get, the more conflicts of interest you have. If you are advising investors, and at the same time you're underwriting initial public offerings of stock, you've got a problem. Because your research analyst clearly is going to say buy, even though that recommendation may not be in the interest of the investor. And we had a huge problem with that back in 2001, 2002. Similarly, if you have a position that you're trying to offload in the market and it's not going too well, you potentially can stuff it into the portfolios of clients who may have other concerns and may not be too visible. So all of these things are potential conflicts of interest, which could lead to, first of all, regulatory reaction, and we've had lots of that. Second of all, maybe even more important, reputational losses. Because if you're trying to run a private banking business and you're basically exploiting a conflict of interest against your wealthy clients, it's obvious that the reputational loss could be many, many times whatever you might have gained in terms of the financial returns. So breadth creates complexity. Complexity involves conflicts of interest. And over time, what's happened is in this business, consolidation has occurred as well, especially in wholesale financial intermediation. So the period just before the crisis looked like this. And these are the large firms, all of them large, complex firms, who were involved in the capital markets, which were at the center of the current problem. I've simply ranked them by business volume. Number 1 was J.P. Morgan, both in 2004 and 2005. Number 2, Citigroup, and so forth. If you take the top 10, their combined market share was about 80% of global capital market activities. So 10 firms controlled about 80% of all stock issues, bond issues, and intermediation flows through trading activity. So it's a fairly heavily concentrated industry, and that means if the system is subject to a shock, it's heavily going to be located in those particular large, complex institutions. So this is the way we define them. They're large, but they don't have to be large. For example, Bear Stearns was not large. It was small, relatively. Bear Stearns was not complex. It was relatively easy to understand. Why was Bear Stearns rescued and sold to J.P. Morgan Chase? Because it was too heavily networked. And this says that there's another criteria, which is too interconnected to fail. And we've been doing some sort of interesting research from colleagues of mine on using network theory and network externalities to pinpoint firms that could be systemic, even though they're not particularly big or complex. So, for example, if you have an electricity network, you could have a substation, which by itself is of no particular concern systemically, but if that substation goes down and the whole grid goes down, you can see the example of too interconnected to fail. And Bear Stearns clearly was a good example of that, as was later on Lehman Brothers, probably, although Lehman, you could argue, was also sizable. So the issues are the too big to fail one, the interconnectedness one, the complexity, that very often management itself doesn't understand what the firm is doing. Certainly, in many cases, the board didn't understand what the firm was doing. And if the management and the board doesn't understand, probably the regulators don't understand. And if you want the best example of that, that's become the Bible in the United States, it's the UBS report that was published in April of 2008. This is the Bible. Every course in banking in the United States today has to read the UBS report because it's 74 pages, it's easy to read, and what you see is people trying to do the right thing, ending up destroying the firm, right? And what you see within and I'm sure it's not the whole story, and I'm sure but it's the only bank in the whole system that's opened its kimono, not voluntarily, by the way, opened its kimono and said, this is what happened to us, right? And what you see here is limits on the governance process, limits on information flows, limits with respect to how you understand risk allocation and capital allocation, misrepresentation and checking on misrepresentation within the structure of the firm. And so this raises a question about here's a bank which for many years outperformed all of its competitors, if you simply look at the stock price, which ultimately destroyed itself. How can this possibly be? Well, that's well beyond what we normally deal with in terms of financial analysis and so on. And then we have the other issue, which is too powerful to control, and this deals with something that Martin Hellwig talked about yesterday, which is the ability of the banks to capture their own regulators. And in a political system like the United States, I'm sure in Switzerland it's different, but in the United States, where money talks, and we have campaign contributions to senators and representatives. I was telling somebody yesterday that every American senator or member of the House of Representatives is covered by 5 lobbyists for the financial sector. 5. And if you figure that they're receiving maybe $250,000 a year on the average, you can see how much spending goes on to try to influence the regulatory structure in the favor. I mean, they're not doing this to support democracy. They're doing this to create better terms for themselves under whatever the new regulatory structure provides. And in the U.S., where we have campaign contributions, I'm really pretty critical about this because I think we need to almost reform the political system as a precondition for reforming the financial system. Campaign contributions, what it is, it's just legalized bribery. and it gives you access. And the access is compounded by lobbyists and lawyers who try to undermine whatever it is that you're trying to achieve. It's a rotten system. And as I said, I'm sure Switzerland is totally different, but that's the way we are. So here's some examples. This is the little list of large, complex financial institutions that come up from these criteria. Some are walking wounded, like Citi, which is really a zombie. J.P. Morgan Chase, which is in much, much better shape. Wells Fargo, and so forth among the banks. Then we have insurance-related LCFIs, which include Berkshire, Prudential, and so on. Then we have American Express, Bank of New York, by virtue of its role in the repo market and in the custody business. Then we have foreign banks, Barclays, Credit Suisse, UBS, ING. I would classify those as systemic. And then we have some insurance-based firms like Allianz and AXA and so forth. This is not a magic list, it's just my own interpretation. There's another list that Standard & Poor's has of systemic firms, which is slightly shorter. There's one that the Fed has, which they don't tell anybody about, because obviously this is sensitive information. So we've got these metrics, and you can identify firms more or less by their systemic character. So the question is, what did they do in the current crisis? Well, this is the map that Martin Hellwig talked about yesterday. You have the house, which looks like it's falling down, which ends up going through a securitization chain, ultimately to be sold as different types of securities to investors who are carrying the risk and presumably get paid for the risk that they take based on the tranches. And you can do the same thing with corporates like leveraged buyouts and so forth. And so this kind of maps it out, and then you can see the role of the rating agencies. You can look at credit default insurance through the monolines and through AIG, off-balance sheet vehicles like conduits and the like. So this system developed over time to maximize efficiency, to distribute risk to those best able to bear it. The instruments became mark-to-market instruments as they entered the markets. There's no hiding in the market. Every day we know what the value of the security is as long as the market is liquid. And what we have is basically two views on this that Rainer mentioned. One is Alan Greenspan. And by the way, both of these are old guys, even by my standards. It's increasingly rare, but even by my standards. So who's older? Greenspan is 2 years older than Volcker. Interestingly enough, Volcker's 83 and Greenspan's 85. So Greenspan says, well, this increasingly complex financial instruments that we've created here in this structure have contributed to the development of a much more flexible, efficient, and therefore resilient financial system than the one that we had 25 years ago. You agree with that? Well, you can agree with flexible. You can agree with maybe efficient, but maybe resilience is not the right word. So then Volcker comes, and by the way, Volcker is a real statesman. He's been around Switzerland from time to time doing odd jobs. And he says, well, this bright new financial system that Greenspan talks about, for all of its rich rewards and unimaginable wealth for some. Unimaginable wealth. One of my former students, John Paulson, over the last 2 years he made $2.7 billion for himself, running the Paulson hedge fund. So I've been up to see him to talk about donations for the university. He just gave us $20 million on Friday for scholarships. What's $20 million? It's nothing, right? So that's to me unimaginable. $2.7 billion over 2 years by basically making a simple bet, which was to short the market, which ultimately. So he says this system has failed the test of the marketplace by repeatedly risking a cascading breakdown of the system as a whole. And so he's really arguing with the resilience in Greenspan. The one thing that makes Volcker a great statesman is that he never commented on how his successor performed. When he left the Fed and Greenspan took over, he kept his mouth shut. And that's what you're supposed to be, supposed to do as an ex-governor. Greenspan's been writing books and so forth and so on, and commenting on how Bernanke's doing. And so when Greenspan goes to heaven, probably St. Peter will give him maybe thumbs down. So here's what we designed. And so this is sort of the automotive equivalent of the financial system that existed back in 2004, 2005. High performance, extraordinarily machine. I had one, which I finally got rid of. Why? Because I always wanted one since I was 17. I always wanted one. Why? Because the girls give you a thumbs up when they, at least until they see who's inside, and then they give you. So finally, when I got old enough, my wife said, "Go ahead, go ahead." So I got a Carrera, not the fancy one like this, but a regular one, and it turned out to be the worst decision I ever made. Why? What's that car made for? It's made for Swiss roads, or German roads, or Spanish roads. It's not made for streets in New York City. We have potholes that are this big and this deep. I ended up with 5 tires and 2 rims. Each tire is $450. I couldn't drive it in the wintertime because it wouldn't stop. And I had to use primitive techniques like steering into the curb to slow the car down. Useless for the purposes that I had it for, not as an institution, so not as a vehicle. So I used the wrong tool for the wrong purpose. So here's another tool. This is a different one, and this is a purpose-built vehicle for motocross or whatever the sport is, and you make certain assumptions, like the wheels are actually going to stay on, and actually, if you saw the guy's face, he probably looks a little nervous. It doesn't hurt right now, but it will in a minute. So what we had here was basically a high-performance regime, which, when stress tested in ways which no one was in a position to forecast, I don't think, maybe John Paulson was, but I certainly was, basically didn't perform very well under those conditions. So here's the crisis in retrospect. You can see here the market. You can map onto it Lehman Brothers and so forth. You can map onto it the central bank's provision of liquidity. Then you can look at the volatility of the markets. That's the VIX. That's the red line. So you can map it out pretty nicely. And the question is, how did the system withstand that period of turbulence in the market? These are the firms that ultimately booked losses. This is as of 2 weeks ago, according to Bloomberg's estimate. So the largest loser being write-downs is Wachovia with $102 billion. And then second is Citi and so forth. And then next to everyone who died, I put a little cross over on the right. And then the ones who were taken over by the government or substantially under government control, I put a G. And the C's are conversions. These are investment banks that converted to bank holding companies to gain access to government liquidity and also other support. And then I put on the left the little carrots. Those are all the LCFIs. So you can see among the biggest losers ranked from 1 to 50, about 3/4 of them are large, complex financial institutions. So you can see they were right in the middle of this process, and to the extent that they are systemic, they needed to have a safety net built underneath them, and somebody had to hold up the safety net. So this is what happened to their market caps. I often use this. Citigroup in, when was that? In March of 2007 was worth $252.8 billion, and in February of this year it was worth $13.6 billion. So he basically destroyed the bank. So the little green circle is what they're worth at the beginning of this year. The blue circle is what they were worth back in 2007. And you can see they did very differently. Why is that? Citigroup and clearly Bank of America performed very differently from HSBC and JP Morgan. As I keep telling people, this chart was made by JP Morgan because they look pretty good relative to their competitors. So what was the problem? The problem was you had underpriced, undercapitalized guarantees. Helwig talked about that yesterday in terms of asset-backed commercial paper, SIVs and so on. They basically they confused their role as a financial intermediary with their role as an investor. So they retained the top tranches, the AAA super senior tranches, on the balance sheet, and they made a significant carry in terms of the cost of funds on what they kept in the balance sheet. So instead of being exposed to pipeline risk, which is the risk associated with origination and distribution, they took what we call warehousing exposure. They actually invested in the same stuff. So that when the crisis ultimately came, this is the way it looks. A friend of mine put in the pigs in the trough. They got a little greedy. So when you look at the data, you can see how much of this garbage, which turned out in the end to be garbage, ended up on the balance sheets of the intermediaries. It's really astounding. That should have all been passed off ultimately to investors. That's their role. Their role is not as an investor, their role is as an intermediary. And so you can see here that non-agency AAA, which are the AAA tranches, including non-investment grade, were heavily lodged on the balance sheets of firms. And we also see a very low correlation between the importance of the firms in that process and the losses they actually took. So there are firms with very large market shares like Goldman Sachs that took virtually no losses. There were firms with much smaller market shares like Wachovia who took huge losses. So that means it's not just your market share that explains the performance, it's also what you actually did in the process, investing versus intermediating. So clearly you have a problem with respect to mispriced and unpriced public support. You have a problem with respect to the share price. This looks at the stock price for the major players. I put UBS in black, Goldman Sachs and so forth. You see a fairly heavy correspondence as the crisis hits, but then very strong differentiation, let's say, in the period as of Friday of last week. For example, Goldman Sachs, which is the top black line, versus, let's say, Citi, which is the blue line, after the crisis versus before the crisis. So there's very strong idiosyncratic performance of individual firms. So here's the way Joe Ackerman describes it, and he's a good Swiss guy, and he's generally very thoughtful about things. And he gave a talk at the International Institute of Finance in April of 2008, and he basically said, what happened here? Number one, we screwed up big time. We have poor risk management and lack of common sense. These are just the words he used. Massive over-reliance on flawed models. Martin Helwig talked about that yesterday. Inadequate stress testing of portfolios, especially with respect to tail events or low probability, big impact events. And especially, as he stressed, correlations that we hadn't seen before across asset classes. Thirdly, inadequate concerns about liquidity risk. When liquidity goes away, what do you mark to? There's no market. So how much is the stuff worth? And just before that, conflicts of interest. And then finally, irrational compensation practices not linked to long-term profitability. So this is nice. He says, the public perception of us is clever crooks and greedy fools. Now, we know that's not true, but that's what people in the U.S., I don't know about Switzerland, people are angry. They are really, I've never seen them as stirred up about some issue as this one. And this is the ordinary person in the street. And in fact, bankers in the U.S. have sunk down to the bottom of the social pecking order, just ahead of insurance salesmen and lawyers. Academics, of course, at the very top of the scale. So Joe Ackerman says, well, we have to clean up our houses and don't leave it to the regulators. Well, too late. The train has left the station. It's too late for that because it's now a social problem. And as we always hear, socialization of risk, privatization of return is politically impossible. So there's going to be a correction of some sort. So here's my cartoon. There's the banker talking to the regulator. There's the gorilla on the right, and the regulator says, well, he's in charge of market discipline. Nobody understands the market, so we're going to concentrate on the discipline. That's kind of nice. That comes out of the Financial Times, which normally doesn't have a sense of humor. So what do we do? First of all, can we rely on market discipline? Well, we got some problems with respect to governance. Some of those have been publicized. Most probably have not. We have problems with respect to board members in terms of their expertise in simple issues such as financial accounting. That's amazing in the U.S. case of board members of financial institutions that were really quasi-illiterate with respect to things that they ought to know, even members of audit committees. It's just astounding. Technical expertise very often slips by because the generalists at the top of the organization have inadequate information and inadequate expertise on the technical side. Very often, asymmetry between risk and returns. The revenue producers, they're the guys who are making $1.5–2 million a year. The risk guys who are supposed to be getting paid for things that don't happen, as opposed to things that do happen, are getting paid $130,000. And it's an uneven contest between the return side and the risk side. And very often you see the risk being steamrollered by the return side. So this is, again, a question of governance. This is the firm itself that has to maintain that symmetry. And then, of course, in financial firms, you have a special issue with respect to the complexity of the business. We're not making steel sheet. We're operating on this enormously complex platform. We have information flows and sometimes a melanoma problem. You know, melanoma is a small skin cancer which doesn't look all that important, but it can kill you. This is a typical case is AIG, where the AIG FP, the Financial Products Group, was so small relative to AIG, you couldn't even see it on the balance sheet. It's what the technical term is a pimple on an elephant's ass. And it ultimately destroyed the firm. What kind of governance process actually is capable of capturing those problems and the confluence among problems like that? And then we have significant problems with respect to the regulators. Very often, it's been argued anyway, that boards have outsourced governance to the regulators. They simply comply, and if they're in compliance, they reduce some of the effort that should have been applied within the due diligence and boardroom behavior process. So the last thing has to do with the issue of regulation. I wrote an article with a friend of mine in the Neue Zürcher Zeitung, which I like a lot, obviously because I wrote it, and it deals with pollution. You know, if you have a steel company, which looks like that, they make steel the best way they can, right? They try to produce the best quality steel, the cheapest cost, the best technology, and they blast garbage into the air. Why? Because they're using a resource that's not priced. Nobody charges for that resource, so they're going to produce steel in the best way without any pollution control. Meantime, you got Mrs. Jones over there who's trying to hang her laundry, and her laundry gets soiled by the pollution. This is what we call the VPP, or victim pays principle. So Mrs. Jones is paying part of the cost of producing steel. That's really what it is. So Mrs. Jones says, well, I don't like this, and the steel company says, well, go away. So Mrs. Jones says, well, I'll get together with other Mrs. Joneses, and eventually we'll have millions of Mrs. Joneses, and we'll take our case into the political system and get a set of legislative and administrative actions in place, which then forces the steel company to reduce its pollution to ambient quality levels that society considers to be acceptable. That's called PPP, or the polluter pays principle. Now, how that happens is up to the steel company. The steel company can change its processes. The steel company can put in stack emissions filters. That's up to them. Let them do that, because they're the steel guys, right? But when you do that and you cap this resource or you charge for it, what happens to the price of steel? It goes up. Therefore, people use more plastics or more aluminum, and steel use declines. So the more pollutive stuff gets replaced by the less pollutive stuff. What happens to the return on capital in the steel industry? It goes down. So less capital is applied to the steel industry as opposed to other activities. So the polluter pays principle is a technique that we've used in environmental policy for decades. Very simple. It just simply says you internalize the external costs, and then you let the industry itself decide how to adjust to it. What's the relevant to banking? If you consider systemic risk, it's a form of pollution. Banks do what they do, as we've seen. They do things that are logical, that are sensible for them, but they are not charged for the systemic risk that they produce that ultimately has to be paid for by the general public. So how do we deal with it? If you apply polluter pays principle, you put a charge, for example, additional capital or some other technique, on large, complex financial institutions. First of all, you put a basic capital charge on, as you do in all banks. Then you put a capital surcharge on institutions that are large, complex, and systemic. And then you might put another layer of capital on firms that are in activities which are considered to be casinos inside public utilities. And you put those charges on and then let the bankers decide what to do. One option would be to get out of that business. Spin off the investment bank to the shareholders, take the proceeds and either pay it back to your own shareholders or to invest it in the private banking or invest it in retail banking, whatever. Another option would be to, well, those are really the two options. One is to pay the shareholders, the other one is to reinvest in other businesses. And in the process, that bank may become unsystemic. And the new investment bank may also be unsystemic. So we take a large, complex firm, which is systemic, and you let management basically respond to the new charges by effectively developing a strategy which reduces the population of systemic firms in the system. That's one way to do it, and we have lots and lots of regulatory reforms, as Ryan has mentioned, that are aimed at that. And probably there are 20 or 30 of those. We also have huge debates about who should be the regulator in the U.S. This is an ongoing thing. Should the Fed, the central bank, also be the systemic risk regulator? In some sense, they're in the best position to do that because they are the ones that are the lender of last resort. They're also the ones who have a significant role in creating conditions under which firms can get into difficulty. On the other hand, we value an independent central bank. Maybe this is true in Switzerland too. And the more you get involved in micromanaging and structures of financial institutions, the more politicized you become, and the less you lose your independence. And I think in the U.S. the big concern is that the Fed, in our case, has really pushed the envelope in deciding who lives and who dies and who merges with whom, that it's too late to unpoliticize yourself. And that may have a long-term consequence on monetary policy in the U.S. There are lots of alternatives in terms of having alternative regulatory structures and so forth, and then regulation by function for firms which are functionally focused. So last thing would be, maybe I'll stop there, incentives and compensation. I want to talk about that for a minute because people are going to ask me that question. Because in the United States, the only thing people are interested in is compensation levels in financial firms. So the question is, how do you design a system inside firms which is in fact incentive compatible, and which contributes to stabilizing as opposed to destabilizing financial firms? So if you look over time, we have a colleague of ours who's been working on this, and he's looked at the financial sector wages, which includes salaries, bonuses, and so forth, all forms of compensation, as opposed to total private sector wages in the U.S. And the red bars are recessions, and the green areas are periods of rapid economic expansion. And what you can see here is around about 1980, the share of total compensation of the finance sector just rose dramatically, consistently through that period from 1980 to now. By his calculation, using a historical perspective, bankers are about 40% overpaid as a profession. So those of you who are bankers, you should give some of that money back. Why is that? Well, why is it so exciting? Because you've got all the myths. So here's the compensation committee of the board. On the left, you got the compensation consultant on the right, who, in popular mythology, these are the optics of the problem. And then you get quotes. This is the one I got the other day. What's the worst thing that could happen? We make $200 million and then we get fired. It's not so bad. Make $200 million, then you get fired. So this is a trader in 2007 who began to learn about the correction that was happening in the subprime sector. And he says, hey, what? This is, by the way, not for the whole group. This is for him. $200 million a year, which, by the way, it's out of the tail, but it's not impossible. We have one guy with $100 million, which became a cause célèbre in the current environment. So you got to make some reforms. So what do you do? How do you deal with fake alpha or outperformance today, which turns into underperformance tomorrow? And this is, again, where the Swiss lead the way. In some ways, UBS, then Credit Suisse. Credit Suisse had this wonderful thing for a while where they paid part of the bonus in garbage. Lovely. So you actually get paid part of your bonus in the stuff that you're cooking up to sell. This is a little bit of a footnote in the system, but nevertheless, the whole idea of bonus, lockups, longer-term contracting, maluses, and clawbacks, that all makes sense. If you can come up with a system which is incentive compatible and gets people to behave in such a way which is consistent with the institution's own stability, and in the process makes a contribution to the stability of the system. So there are a lot of questions here. One is, can you really withstand the pressure of competition? You're already seeing a lot of cheating. Even in the case of firms which have adopted more sensible systems in the U.S., you're getting people walking out the door because the competition is not abiding by the same rules. You sometimes lose whole teams of 7 or 8 people, and you're out of that business for a couple of months before you can rebuild a team. So the interesting question is whether this set of sort of positive intentions will in the end fall victim to the dynamics of competition for human capital among the financial firms. Can you come up with a code of best practice? I still have enough faith in human nature to think you might be able to make some progress, but the real world tells me it's going to last only over lunch, and after lunch they're going to go back to business as usual. And secondly, what is human capital? Why is it that individuals are worth $40 or $30 million in a year when you have a human talent market out there which ought to be somehow functioning, and there should be an increase in the supply of talent to the industry? On the other hand, you pay professional athletes the same way. There are athletes who command those kinds of compensations, and the reason why is because they're better than anybody else. So, in a sense, a lot of the compensation issues, which again are related to governance questions and stability questions, which make this whole story substantially more complex than it otherwise might be. If you are really a curmudgeon like myself, the big debate now is there's Volcker again, now debating with Tim Geithner, our Secretary of the Treasury. And Geithner says, well, these types of systemic institutions that we've been talking about need to have differential regulation, for example, higher capital, lower leverage, and so forth. And we can devise a regulatory architecture which achieves the higher level of stability we're looking for at relatively acceptable cost. We know it's going to make the system less efficient. It's also going to make the system less creative, but that's a price we have to pay to have a higher degree of robustness. And we can do that by engineering a regulatory system which is efficient in the sense of reducing the costs of regulation. Volcker, who's been around a long time, he says it's not going to work. And the reason it's not going to work is because those who are regulated will get busy about 4 days after the regulation takes effect in order to try to undermine the letter and the spirit of the regulation. So Volcker has become a political realist, and he says, in my long history in this business, I know that we've got lots and lots of smart people who will set about going to work, coming up with different structures, different ways of effectively end running the stability attempts that the government applies. So Volcker has come down to the story that you have to carve out of these large utilities certain businesses that don't belong there, don't belong in quotes. That includes large-scale proprietary trading, running in-house hedge funds, and so forth, and that these should be carved off. Obviously, we need risk-taking, and we need the speculative activity in the markets that they provide, but they should not be provided inside a public utility. And so Volcker has swung around to this particular interventionist position, and guys like me, you know, I'd like to think that Geithner's right, but I'm getting older too. And the older I get, the more I feel like my own grandfather. My grandfather, when he finally died at 97, and I was 16 or 17, you'd come up with a great idea, and my grandfather would say, it's not going to work. And let me tell you 19 reasons why it's not going to work. So he became sort of a curmudgeon. He'd seen too much. And that's a danger too. And I'm sort of drifting in that, I feel myself drifting in that direction. And so right now, among some other academics, as well as the governor of the Bank of England, Nelly Cruz in Brussels, have sort of formed a coalition around the Volcker position, not because it's the best choice, it's the second best choice. But it's almost an admission of defeat that we're going to have to go to some kind of a carve-out system in order to achieve stability. Obviously, others disagree. The banks clearly disagree. And what we've got now is a huge battle to see what direction we should take in order to get a system which is more robust, at the same time minimizing the associated efficiency losses. Thank you very much.
Permettez, on va peut-être prendre 2 minutes de pause juste pour voir encore s'il y a des questions, et puis je poserai les questions en anglais aux conférenciers, et puis pour ceux d'entre vous, sinon il y a les casques pour comprendre. Okay. Okay, since there's a lot of questions, I think I will start. So I'll start with very general questions, which says the following. The main goal of finance, isn't it to help companies invest productively and not to enrich brokers through multiple transactions? Do we learn anything from the current crisis or not?
Mike.
Excusez-moi, je recommence. So, isn't the main goal of finance to help companies invest productively and not to enrich brokers through multiple transactions? Haven't we learned anything from this current crisis?
Well, it's an interesting argument. Number one, finance is about exactly what you said. The role of finance is to minimize the weighted average cost of capital of firms. It's to provide seed capital to new businesses and to provide high-risk capital in that context. Secondly, it's to deny capital to businesses which are losing or industries that are losing their competitive advantage. So finance plays a critical role in the sort of birth and death process. An economy is not static. There's always industries growing and industries declining. And finance plays both an efficiency and a dynamic role in this. On the other hand, finance plays a critical role on the investor side with respect to old age provisioning, with respect to the insurance sector and so forth. So that's what I had on my map as the core functions of intermediation. In the meantime, of course, you trade. And you trade partly because there are inefficiencies in the market which allow you to trade profitably. You trade because you provide liquidity. And that means a large institutional investor can change his portfolio without significant impact on market prices. So trading by itself is not a useless function. Liquidity has value. And that's extremely important. On the other hand, you have proprietary trading as opposed to client trading. Now, is that a different function or is it part of the same function? Do you have to be a prop trader in order to do a good job for your clients? The big investment banks would say yes. We have to take proprietary positions because otherwise we are out of the transaction flow, we're out of the information flow, and we can do a better job for clients by trading for our own account than we would otherwise. The question is, though, how much of that is, first of all, valuable from a liquidity perspective? Second of all, how much of it is exploiting your privileged position in the center of the markets? Because you do see ultimate client flow, and it's very easy, given that information, to use that information to capitalize on that information yourself. Third issue is you do have front running. We were just talking about flash trades, where we currently have high-speed computer-driven trading, and you signal a particular position for 1/100th of a second to the market, and that allows an insight into the market to some players which other players don't have, and it allows them to execute effectively to front run the market. It's a huge controversial issue right now about whether that should be banned. So we have significant contributive activity from trading activity, but we also have the abuse of the market and abuse of privileged position. And my concern is that the current crisis has increased the capacity to abuse. You look at Goldman Sachs today, and you look at their trading revenue. It's absolutely astounding. Now that they have 3 fewer competitors, what a difference that makes to market efficiency. And they're clearly taking advantage of that for their own account. The market has become less effective from a client perspective, but much more effective from a proprietary trading activity perspective. What that does is it redistributes wealth from one group to another group.
Okay, there's a few questions about the next crisis. So somebody's asking, can we expect another crisis coming from the huge carry trade against the US dollar? If yes, are central banks to some extent contributing to this risky situation with the monetary policy?
This is a good one. I always get very upset about the carry trade because that's not what I teach. So when I teach international finance and you have an interest rate environment of 6%, another interest environment of 12%, you borrow in the low environment, invest in the high environment, and then you take a hedge to cover your exchange risk. And if you take the cost of the hedge out, then the effective cost is about the same if interest parity works. So the carry trade obviously involves making that trade without covering the currency risk. So it's basically unhedged positioning against an exchange rate movement. In the case of Iceland, great example, massive carry. You had about 18%, 17-18% Icelandic interest rates, close to 1% in Japan. So, hey, free lunch. But whenever there's a free lunch, you should ask yourself, why am I so lucky? Right? So the question here has to do with the US dollar. So you have a massive carry against the dollar. We know that. We know what the open positions are. And that depends very heavily, the profitability of that arbitrage, if you want to call it that, depends on the dollar not dropping precipitously. You look at U.S. monetary policy in the context of the crisis. We got a huge overhang, and how do you deal with that? One is you raise taxes, or secondly, you cut spending, or thirdly, you let inflation drift up. Those are the only three ways. If we went to an inflation rate of 7-8%, within 2 or 3 years using compound interest, the overhang would more or less disappear. So one possibility would be that the U.S. will take the path of least resistance, which is to let the inflation rate rise. Why? Because Obama has lots and lots of promises. Health care reform, he's dealing with Afghanistan and so forth. So he's kind of stuck on the expenditure side. Taxes, he's going to raise taxes on people like me, the so-called rich. The rich are people with over $100,000 in income, which doesn't sound all that rich. My tax rate now at the margin is 51%, including state and local, and I'm looking at about 60% after the Obama. So he has relatively little elasticity given the target pool of taxed individuals. So what's the option? The soft option is permissive monetary policy, effectively monetizing part of the overhang. Then you look at Europe. Here you have ECB. The ECB is not captive of any single political system. The ECB is Germanic, therefore much more focused on the retention of the value of the currency. You could easily imagine a scenario where the ECB maintains a relatively tight monetary policy while the U.S. pursues a much more liberal monetary policy. So you could see a story where the dollar drops possibly another 10, 15% against the euro, which is the most important price in the world, and many of these carries are likely to come to grief under that type of scenario. So I think that it's a very good question that people are puzzling about.
Next question about the next crisis. Do you think that the next financial crisis could come from the state debt?
State debt? Yes. I hope not, because I'm heavily invested in state and local bonds. This is one sector that has been spared. We have had no meaningful increase in defaults. Even in cases like California, which is a basket case, we have a clear tax advantage as an American resident of buying municipal bonds. And so far, they've been able to adequately service that debt. But if we're talking about a macroeconomic story, which is an extended J, with prolonged weaknesses in the real sector, which therefore undermines the tax revenues of the states, you could very easily see a problem of both either refinancing or, in some cases, potential defaults, in extreme cases, potential defaults. So I think the answer to the question is it depends how the macroeconomy does. If I'm right and we're reasonably optimistic about the next 2 years or so with a gradual recovery, I think the states will make it through that process, although some will have to do a lot of scrambling, including local and state taxes, such as California, to achieve that.
Thank you. So now there's a few questions about regulation. So the first one says, you saw how the SNL failed after the deregulation in the early 80s. Did that not inspire you to not deregulate the banks? Well, history always repeats itself.
Yeah, well,
it's you personally, but...
Yeah, well, who was it? History doesn't repeat itself, but it has a fairly good imitation of itself. So I was just thinking about that this morning. We had a big crisis. My first big crisis was 2001 with the emerging market debt problem, which surfaced in 2001. That took 10 years to work out through the Brady plan and so forth. Then we had another big crisis in 1991, which was 10 years later, which affected heavily the real estate sector. Then we had another big crisis in 2001. So it looks like we've had about every decade crisis. Meantime, we've had many crises. We had long-term capital. We had the emerging market Asia crisis in 1997, 98. So I think crises are part of the system. They could be shocks coming from the primary sectors such as raw materials. They could be shocks which are sovereign related or whatever. And I think probably in my professional career, maybe I have another 10 years to go, I'll probably see one or two more. The important issue is you need a system which is sufficiently robust to ride through these crises. Because the fact is we don't know where the next one's going to come from. Could involve this sector or that sector. Could be heavily focused geographically. Could be globally, for example, in a particular market. So I think robustness is the key as far as not amplifying whatever the crisis is, and secondly, making sure the system works continuously through that crisis.
Okay, so another one on regulation. Don't you need nowadays a worldwide regulator because of the globalization of the financial sector?
Well, it's not going to happen, so we don't even have to talk about it. On the other hand, it is important because whatever regulatory structure gets in place has to be clearly linked to what happens elsewhere. Finance is sufficiently mobile that financial flows on my diagram will simply redirect. This is what we call the net regulatory burden. Regulators are not just bad people who impose costs. They're also people who provide subsidies in the form of a properly regulated market and so on. So financial flows tend to move to where the net regulatory burden is lower. In this case, we're talking about major changes in regulation which could affect that balance, that net regulatory burden, and it clearly has to be negotiated and not necessarily harmonized, but pretty close to it. And that means, I think, we have probably four major players in this. There's the U.S., there's UK, a country like Switzerland, maybe the EU. And once you have that, people will fall into line. And if they don't fall into line, then we have certain ways of dealing with countries that don't. And you can set up a cordon sanitaire, you can do this, that, or the other thing, in order to provide the requisite degree of harmonization, which then makes each system capable of withstanding these shocks.
Okay, so now there's two similar questions. One may be more angry than the other. So I'll read the less angry one. So regulatory reforms, really, shouldn't the entire casino be closed and the banks return to their basic functions, savings, lending, and some risk-taking for 1+2? And the related question says, shouldn't the whole financial system be dismantled, sort of?
Well, good luck. If you want to go back to the caves, it was a simple life. But the fact of the matter is that banks perform critical roles. One is just a maturity transformation. People want liquidity. They want an outlet for their savings, and at the same time, we have people who need capital for capital investment and so forth. And somebody's got to do that. In any system beyond the most primitive, and that was carried out clearly by commercial banks, and it was also carried out by investment banks. One of the interesting things I've been trying to think about is suppose the United States in 1933 had not separated investment banking, which is where much of the risk is, that the question implies, from commercial banking. Suppose we had universal banking of a European type from 1933 to 1999, 66 years. What would the U.S. system have actually looked like had we had a European type system during that time? Well, we don't know, but we can speculate. So one speculation would be there would have been no commercial paper market in the U.S. Wouldn't have existed. Just like in Europe, banks resisted like crazy setting up a commercial paper market because it was competing with their own intermediation functions. Similarly, a lot of innovations would not have appeared had you had a universal banking system during that period. So during that entire 66 years, probably, we had significant gains. We created an enormous export industry. It's our second largest export industry is financial services, which probably wouldn't have been had we had a European-style universal banking process during that time. We had competition between investment banks and commercial banks, which created a dynamic for a lot of innovation during this period. So you can make an argument that actually the unintended side effects of Glass-Steagall could have been positive over that whole period. We'll never know because we can't run the world twice, once the way it went and once the way it might have gone. So here what we had in a way was the best of both worlds. We had the core functions of banking, which were put into a utility type framework, and then we had the risk-taking functions, which were put into what we later on called the integrated investment bank. And that's what then got rejoined in '99, again with some unintended consequences that some of us didn't really appreciate.
Ask a last question. There were actually two questions related on sort of the dollar as a world currency. So one of them says, what do you think about the world currency not connected to any deficit or currency? Would it be a way forward? Are policymakers thinking about such an idea?
Well, since I was a student, that idea has come up to effectively replace reserve currencies with some artificial creation. Initially, it was the special drawing right of the SDR and so forth. The problem with this is you ultimately need markets that select for themselves what they want to invest in. Where the liquidity is where the flow is going to go. And that's one of the reasons why we have the preeminence of the dollar as a numeraire. We have a global imbalance problem, it's absolutely clear, which has contributed to the current crisis. It's pretty clear that if you look at the sources of funds looking for excess returns, whether they're Chinese reserves or sovereign wealth funds, they clearly pushed into the market and provided much more liquidity than would have happened had we not had the global imbalances problem. So now you have the dollar. The dollar is in question. The Chinese never talk about it because it's not in their interest to talk about it, given the size of their dollar reserves. And when I go to China, and somebody always asks this question, they say, what are you going to do about the dollar problem? So I always say, what are you going to do about the Chinese problem? You know, it takes two to tango. The only way we're going to end up saving more and absorbing less is for the Chinese to end up absorbing more and saving less. Unless you're trading with a man in the moon, it takes two sides, right? And so the question is whether or not this build down of the overhang is going to occur in an orderly way. The Chinese will always tell you they agree with that, but on their terms, which means progressively, in concert with their ability to build domestic demand to replace export demand and so forth. And at the end of the day, the U.S. is going to get poorer and the Chinese are going to get richer. The terms of trade will simply shift toward China. We all know that, and we accept that. The key issue is to have that occur over a sufficiently gradual and digestible period of time to ultimately bring about a build down of this overhang problem. And I'm personally fairly optimistic. When you look at the Chinese ability to reflate domestic demand in the current crisis, it's just astounding. I never would have thought that their stimulus package would have been as effective in increasing domestic demand for products to effectively replace the collapsed export demand. So that shows there's probably more resilience in the Chinese structure than we thought. A lot of pent-up demand or unsatisfied demand, which still has to come into the market. And Americans finally are in fact saving more and building down their household debt in a serious way, which again is not necessarily in the interest of banks, but they're doing so seriously. So I think unless this is again a short-term phenomenon, I'm pretty optimistic that the dollar will survive that process. That doesn't necessarily mean it's healthy, and it doesn't necessarily mean that we shouldn't begin to see the euro take a much larger role as a transaction currency than it has in the past, with the burden effectively being taken by the dollar.